Hello and welcome to a brand new show of Market Makers. Well, we are back after a break and we are back with a market veteran. My guest on the show today is someone who has seen, predicted and analyzed many bull and bear market cycles right. His understanding of valuations and to connect the dots and talk about business cycles is absolutely impeccable. So with great pleasure, let me welcome back N Jayakumar, Managing Director of Prime Securities. Jake, welcome back. Thank you for joining us.
Thank you.
Well, last time when we spoke to you, markets were a bit tentative. Global cues were not strong and supportive, and the current environment is absolutely rock solid. You know, you're getting feeling of a child who's going to a carnival where everything looks good.
Well, there are risks in that kind of a scenario as well. But I remember when we were on show last, I think we had just seen the first phase of the Indian, the corporate sector. The first flush of restructuring, as it were. That NPAs were now becoming a more accepted word, and people were looking to restructure balance sheets. But most importantly, since then, we've had one of the greatest legislation changes in this country has seen, which is the introduction of the Chapter 11 equivalent bankruptcy, or the NCLT, the bankruptcy code, as it were, that's been now implemented. And you have the NCLT, and I think that's going to completely change the way businesses are going to be and bring about a certain, should I say, mobility in the way resolutions of problems happen. So I think if we were to just take a lead from where we left off last time, it is that corporate India was just getting to grips with problems and was beginning to take cognizance of what it needs to do. Banks were beginning to understand that they had to either reduce debts or take hits or whatever, and that capitalization of banks was obviously grossly inadequate. But from that to now, I think we've moved a fair way, but maybe people see this as not enough action because these big, restructuring stories are still stories and they've not been resolved. But I think the NCLT is going to be the way of the future. The resolution of these big corporate debts, bring them down to debt levels which are manageable, and declaring people whether willful defaulter or whatever. That process has to play itself out. And maybe there were too many chains that people had around their feet, as it were, to take decisions quickly. But I think, to my mind, the next phase of corporate growth, private investment, will be in the backdrop of a resolution mechanism that's going to be as robust as anything that we've seen.
So is that the reason why markets are going higher, because markets are now betting on a new cycle?
Well, I think it'll be difficult, except when you look back, to figure out what's changing. But if you look at it, I think there are 3-4 things that the market is now beginning to see. One is that I think the growth engine in any market has to be clearly defined. And I think this cycle is led clearly by the PSUs. Investments will come from PSUs. The big value creators will be PSUs. The big listings in the market will be PSUs. And I think that's in keeping with the number one person's stated vision, which is to galvanize the PSUs. And these are investments made over a period of time that are not yielding results, and those that are completely chronically ill, either to shut down or to actually merge. So while that is on, it's equally true for banks, which is one class of PSUs that have been listed for a long time, and there you're seeing consolidation, which is inevitable. So while you have determined that the primary engine is going to be PSUs, but the restructuring and the attendant issues around it has obviously put the private sector in a bit of a spin, and people have gone into their shell saying we are not going to invest out here, we don't know what's going to happen, etc. Because the private sector has never been, in a sense, answerable for loans taken. That was really the big bane of the Indian PSU banking space. But today, for instance, when you have a system where, due to genuine business and other exigencies, that companies go sick and you have a resolution which is equally sort of professional, then I think you'll have the confidence coming back. So the market is betting on the fact that sooner rather than later we'll come to an end as far as the big vehicle of supporting this growth, which is the PSU banking space, and the big restructuring conglomerates. And I'll just mention one interesting aspect. The question that keeps coming up is, what is it that's moving some of these big conglomerates? I don't want to mention names, but when you say conglomerate, by definition, it has multiple subsidiaries, some in power, some in roads, some in engineering. That's a typical,
that's how you define,
and that's a typical sort of look and feel of a listed group in trouble, if you will. And everybody touts, nobody knows their revenues, nobody knows EBITDA, etc. But everybody knows group debt is 60,000 crores, 50,000 crores, etc. Interestingly, over the last 2 years, some of these, if you analyze the subsidiary, where banks have converted their debt into equity, some of them have gone into NCLT, some of them have moved where they have brought in foreign equity. And if you see this, then the consolidation under Ind AS is basically when your holding is 51% or more and where your management control. But where your management control has been lost because banks have taken control or a foreign player has taken control, typically in the case of energy companies, then guess what's happened? Your enterprise value, which is equal to debt plus equity,
debt component
has come down, so the equity component suddenly starts. So the market is sensing this. Again, enterprise value was not born out of isolation. Enterprise value was an EBITDA multiple. The EBITDA for most of these subsidiaries was negative. So you eliminate those and now just add virtually the positive EBITDA making subsidiaries. You find that the EBITDA multiple gives you a higher enterprise value. Debt value has gone down. So hey presto, the equity value suddenly starts moving. I think this is a very fine change which has not been talked about, and the market really, if you ask me, in its wisdom, which is the aggregation of small, has started moving up. So if you see some of these groups, they're up 70–80% from bankruptcy levels.
That's because of a low base checks. 10%.
But from bankruptcy levels. Remember one thing, the equity value never goes to zero. Because equity value by definition is an optionality. It never goes to zero. So let's say the enterprise value is only determined to be 500 crores, but the equity value cannot be lower than zero. So notwithstanding what the debt is, equity will be 0 plus minus whatever, 0 plus something, it can be minus. But if you eliminate the bad portions, the good portions, valuations suddenly start shooting up. And we've had a few restructuring cases recently which have indicated that. So all I'm trying to say is that this restructuring process is going to bring about the, in a sense, a resuscitation of some of these fallen giants, if you will. And I think we are seeing some of this in play as we speak.
Do you think the leadership in the market is changing? Suddenly this year Reliance is one of the biggest outperformers. It's no longer Eicher Motors, or it's no longer, Page Industries or Asian Paints. Are you getting a sense that we've shifted from what could be called as a quality at any price rally to cyclicals which offer better visibility?
Well, I don't want to actually brand it in that manner. The way I see this is that markets are, this is a rally which is it's like a slow grinding nifty rally, which clearly tells me that there is enough and more worry at every level, which means that as long as people are worried and people know the reasons they are worried and therefore will not invest everything, they will not go the whole hog into the markets, markets are not going to come down. Markets don't come down when people are worried. Markets don't come down when people are cautious. So it's a brilliant market because it's almost the most amazingly well segmented rally, which means that in the same industry, stocks are hitting new 52-week highs and new 52-week lows, with equal ferocity. So I think the market is a differentiating market. And the other thing that's changed is that we used to believe that foreign capital was the sort of, the holiest capital, the most, virginal, pure and the cleanest form of money that we need. Not true. So in a sense, you don't need 18 big pension funds to put money in. If India as a whole increases its percentage allocation to the equity markets from, out of its savings, which is what is happening. And, as I think your channel or your newspaper kind of said, as sips become gulps or whatever. So I think it's very clear. I think that the allocation of money into the markets is increasing. And as I've been mentioning on a couple of fora, where I think we are in for a period of extended period where markets will be optically expensive. Markets will be, and we'll keep hitting headlines for saying it's the most expensive market in the world, and there'll be good reasons for doing so. So markets will be optically expensive, but there'll be enough and more because you've got 10,000 stocks to choose from. And I think that is going to be the way forward, where kicking the tires and sort of getting your hands and feet dirty, going out to spot the winners will be the way forward rather than putting money into the markets. And you can get normal index appreciation. But when was the last time that you had a rupee appreciation, foreign money coming into debts, into debt markets, but equity getting sort of much less of a flow? But of course, debt markets also, I think, have bottomed out, so money is moving out of there. But in general, the kind of flows into the equity markets from the length and breadth of India rather than from identified pockets is creating its own kind of a bull market move, as it were, where what I call this is a grinding market, where you'll have a Nifty going up 50, 80 points, going down 40, going up 60, going down 30, that kind of a move, which is not optically euphoric, but at the same time the underpinnings are very sound.
You know, like a common friend of ours, you always says that bull markets, they climb the wall of worry and they come down on the ray of hope. Markets will peak out when there is participation. And if I look at the IPO market, I mean, the participation levels are absolutely unreal to believe, whether it is DMart or RBL or what's going on with in those, you know, those Chotu and Chintu IPOs, the word which we use in on Dalal Street commonly.
Well, I don't think participation there should be viewed as participation. There should be is the index of FOMO, the fear, the left out feeling, if you will, fear of missing out. It's not that the money that doesn't get allocation there moves to the secondary markets. That's not the case. I think people, in some sense, people like fixed price issues. So good quality issues are getting subscription. It's not that all issues are getting subscribed, number one. And number two, the issue size, if 10 issues or 12 issues in a year do well, and average money being raised is even 1,000 or 1,500 crores, what is 20,000 crores? That's not indicating, because that's all they're raising. It's not that if you get 2 lakh crores, that all 2 lakh crores are getting retained by the company. That's not the case. So participation is there in terms of people wanting, but it's not that people are getting. And I think that's resulting in the kind of a SIP sort of movement where people are saying, let me keep, I don't want to miss out on this, so let me keep dribbling away. Will there be corrections? Of course there will be. Will there be sharp corrections? To my mind, the fact that you don't have these aggressive upside moves is almost eliminating the need for aggressive downside corrections. So the corrections will keep coming, but this will be in the nature of corrections not being deep enough for people to participate and not being aggressive enough, the moves up, for people to feel euphoric. So it's that kind of a weird interim sort of thing. But it's reallocation of money and churning of money from one pocket to the other, whether it's retail or whether the real estate or it's gold or whatever. So
if you have to, let's say, draw a parallel based on experience of market cycles, and if I can draw the immediate parallel, which is a 2003 or to 2007 bull market, where are we there?
I think it's a very different market. There, I think the base was low, activity levels were low, and there was a global reflation. So we were actually beneficiaries of a global reflation. It is not that India stood out. Whereas I'm saying, if you look at the rally this time around, when was the last time that you saw a dollar index which appreciated all the way from 85 to 104, 103, which means it moved up almost 20% or a little shy of that, that you actually had the dollar rupee, which went from 67.5, 68, has gone down to 64.
That's a great point.
So I think this is not a rally which you can compare with the past. I think it's a rally which has got its own feet. I think in a sense is reflecting the lack of choices in the world. There, if you looked at it, global currencies were appreciating. Here, that's not been the case. It's very few currencies, and nobody's been able to better explain. I think, to my mind, a lot of this is returning Indian money. That money parked today is not able to find either returns or safety in parking outside. And in some form or the other, it's just coming back to India. And I think in the past, it might have been by compulsion, it's today by design, because people want to have their exposure here. So, am I a great believer that rupee will go to 55? I'm not sure. But the fact that the rupee has strengthened the way it has, must confess that given that people were so wildly in consensus, as it were, that we'll hit a 72, 73, somehow in the last 18 months or so, I've been trying to take the opinion that forget your own intelligence. See if there is a consensus anywhere and go against it. So here are a few that we've seen. Consensus was on Brexit. Consensus was on Clinton. Consensus was on the rupee going to 72. And in those moments of complete euphoria and moment of those huge despair, if you had actually thought of going the other way, which means go against the trend, I think the biggest money in terms of biggest entry points and biggest exits have happened at that time. So I'll tell you, the crowded trades in the world are getting crushed.
Which are the crowded trades?
So the crowded trades in the world have been, now it's a long dollar trade, which is what they otherwise call the Trump reflation trade. It's really got extended out, and I wouldn't be surprised if there's a big sharp move in the euro upwards and a big move in the sterling pound. In fact, I'm a big bull on the sterling pound, as it was. So if those happen, the dollar index, which now has cracked 99 and gone below, actually to my mind may go down to 94, 95 levels. And in that, can the rupee go to 62? It could. So the big crowded trades have been things like gold. People have been perma bulls in gold. That's now come off. people have been perma bulls in the long dollar. That's come off, and I think we could retest $40, maybe even $35 on oil over a 12-15 month period.
India is really the toast of the town. Emerging markets are overweight on India for valid reasons.
Sure.
So you don't think India is a consensus trade?
You know, India is a consensus trade, and to that extent, I think we have to be careful that a continuous ramping up of the Nifty, for instance, will give you that kind of fear that will we enter into the mid-20s in terms of discounting not just 18 but 2019. Then you would have reached intermediate tops. I think we are far away from that right now. So the fact that FIs are net sellers in the market and the market is rising hardly tells me that India is a consensus trade. Maybe it is lip service to say we are bullish India, but the reality is the ETF and other monies are leaving India. At least that's the data indication of the last 6-9 months. So if you had $15 billion walking into India, over a 6-9 month period, and you follow that up with another period, then I think you may enter into a topping out scenario. I don't think we are anywhere close to a top as of now.
The consensus view is that if not a bust, there is a bubble in mid-cap. That's a very lazy way of identifying mid-cap stocks.
I think what happens also, this cry for correction is more a felt need for a correction rather than a conviction that a correction is on the way. Similarly, the cry that there is a bubble. So as I said, I never said we were in a bubble. I said we are in a bubble-like zone where valuations will keep getting expanded painfully, slowly, and frustratingly because you have not participated adequately, right? And people will keep seeing this. Tumhara market बढ़ रहा है, तुम्हारा market बढ़ रहा है is a frequent refrain. But I don't see participation, and yet when the market does correct to 3-5%, where people should be entering, that's all you're going to be afforded in terms of the leg space for getting in. People don't participate. So I think it's, at the risk of repetition, it's a grinding slow rally where anything like a 3-4-5% correction should be used to buy into, but people don't get into it. And I think in order to sort of obviate all this, people are going through the SIPs saying I can't time the market, which is probably a smart way to do it.
What is the red flag in this market?
Well, plenty of red flags actually. Political, which means some tension somewhere. I'm never, I think the greater the disparity between economic levels and, of neighboring countries, I always feel there is an issue. I was recently in Israel, and, other than the fact that Jerusalem completely sort of overwhelms you in terms of how 3 religions in the world view this as the...
It is an experience.
It's an experience that literally in a 200 square meter area, the 3 religions kind of converge and say all of them believe it's the holy spot. The fact that American money, drip irrigation, and
pharmaceutical defense
can create what Israel has, can create in Israel. But look, everything around that. Every country around that region is actually an adversary. And I think the greatest amount of discomfort is the military intelligence that is used to keep people at bay. So I think that's the kind of thing. You don't want to be such an island of prosperity that you become a natural target for people around who have nothing to lose. So that's always a risk that I believe it's there. Number 2, you don't want to overstress the risk aspect, but actually speaking, things are, I know that ease of doing business, etc., is a good thing, those numbers sort of indicate. But really speaking, we need to see that there are multiple countries in the world where the factors of production, as we call them, down to basics, which is cost of capital, labor cost, energy cost, these which are typical factors, are much cheaper than they are in India. So will we become uncompetitive and therefore only be an export model for things like, and talking of which, pharma, IT, we've not even spoken about. In this entire rally, when was the last time that you saw that IT and pharma were at their multi-year lows in terms of valuation multiples? So the red flags can be plenty. So those were crowded trades, since you're asking of crowded trades, which have got, if not busted, but severely impacted. I mean, there are now leading pharma companies that are quoting at 12, 13 times next year's earnings, which is unheard of. These are hardcore cash-making, cash-spinning out companies, big four auditors, good governance standards, and yet quoting 12, 13 times because the world doesn't want them anymore. So that's the opportunity. So if you're saying in this market, can you get opportunities? I think investing certainly in constantly, reinventing the IT space, for instance, but more importantly, in the pharma space as a whole, I think you can't lose money over a 2-3 year period.
So I'll try and go close to IT and pharma as much as I can without getting into stock specific definition. You know, when I started my career in 2000, you were a market veteran. And the way you and me would define the definition of large cap IT, it was Infosys, it was Wipro, TCS wasn't born in a listed avatar, but it was Infosys, Wipro, and to a large extent HCL Tech. That definition has not changed in the last 20 years. For pharma also, it is Sun Pharma, it is Cipla, we can throw in all odd Glenmark, but the definition of top 3 has not changed. Do you think if somebody wants to buy IT or pharma, stick to the top 3 names?
Maybe even go further. It's not that the others have not evolved. I think the top 10 IT names or the top 10 this thing, even as a basket, you can't lose. Yet, if you were a specialist in them, you could obviously make a better basket than the normal. So I'm saying even the IT index or the pharma index in that sense is actually a buy at current levels.
Jake, without getting into a today tomorrow recommendation, a question which I'm asking everyone on the show is that if I look at Maruti, it went public in 2003 at 125. It has given a CAGR return of 34%, but it's come over a period of about 15 years. If you have to, let's say, buy a stock or an idea for next 15, 16 years where you think from these levels also a CAGR return of 15 to 20% cannot be ruled out, where would you like to hunt? What could be the next Maruti in making for Indian market?
Given the focus this government has on making this an inclusive growth, which means right down to the basics, the Jandan accounts, etc., I have to say that housing finance has to be there, even though the moves have started. I think some housing finance companies, and there are good reasons why multiples to book are being sustained because the growth is there. And with interest subvention, affordable housing, etc., housing finance is clearly one space I would look at it. I would go back to one or two pharma companies, again without names, where I think, and in the past when I could quote names, I would, where I think 15-20% growth over 5 years in stock prices can come. I would go to some of the restructuring stories, where, as I said, the multiple pieces, they are throwing away the sort of energy or the sort of non-performing subsidiaries and ending up with the. So if you go around, and there are only 4 or 5 names like this, so you could where in the restructuring process, a combination of deconsolidating some of the subsidiaries and demerging some of the principal assets will throw out huge value. So I think there are enough spaces and more. IT I'm a little more concerned about because I still haven't got the feeling that some of the top 3-4 companies are cutting edge in the product. So if you were to look at it, I'd still say use your LRS, which is your liberalized sort of remittance scheme, to put some money into an Amazon, to put some money into a Facebook. And I think you can't go wrong.
So stick to the
and
innovators.
I'm saying those stocks because people don't typically, I might own 20 shares of Amazon or 20 shares of Facebook or whatever. But what I'm trying to say is that this is becoming a global way. And the amount being spent by these companies on things like artificial intelligence and growth anywhere where there is growth and the kind of reinvestment they do. I mean, to my mind, Amazon, etc., those are the kind of stories where even if it means testing the waters, we need to go out and start testing. And I think from that perspective, I don't see an Indian company that's moved in this space to say that we are in the next stage where either it's product-led growth or so futuristic that we are going to withstand the short-term pressures of H1B, etc. So I still think IT is a little more suspect, but pharma, to my mind, with generics being the core, is the space to be.
Jake, I'll just get some closing comments from you. And for the longest time, investors have treated Buffett's principles as the holy grail. I mean, you have to stick to what he indicates and what he what is he communicating. But Buffett is changing now. He's bought into Apple. IBM is one of his largest holding. The innovation is happening in Valley, and he's never participated.
He cursed the Wright brothers, but he's back into aviation.
Exactly.
So I think the big space here, if you want, and I can say this here, with the risk of interruption, is that Aviation. It's a space we've not talked about. But the value creation that aviation can give. Look at the way, for instance, they're competing with the railways today. I mean, just the other day, I think a few days ago, somebody told me a return Bombay-Delhi economy was a 31 grand.
No, that's the only sector which I think has managed to register a CAGR growth of about 25% plus for many years.
And go there for the carriers with the highest load factors. 90% plus month on month for 15 months. One of the companies in that space. It's amazing. And the distinction between a low-cost airline and a premium airline and a budget airline, that's all disappearing. With regionalization of airports, more airports coming up, and people traveling with convenience, etc., thrown in the way, I personally think aviation could be a big bull run for the next few years.
Really appreciate your time. I'm glad to have you back, and certainly hope to see much more of you going forward. Trust me, all the viewers, they need this, bullish comfort, and they've got from today's show.
Let's hope it's one is vindicated. Thank you for having me.
Appreciate your time. That's it on this edition of Market Makers. Thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.